Hello, everyone. The Society of Actuaries is pleased to present this webcast titled Solving Problems and Overcoming Obstacles in GAAP LDTI Webcast, sponsored by Valani Global. We are very pleased to welcome all of you to this program. My name is Sarah, and I will be your moderator for this session. You may submit a question or comment on the right side of your screen in the chat area by typing it into the box in the lower right corner of the window. To access the presentation slides, please see the Materials section at the bottom right of your screen. Additionally, you can go back to the virtual meeting page and click on the Handouts tab. We would like to remind you that the SOA adheres to a strict antitrust policy. For more information on the antitrust policy, please visit the SOA website. One final disclaimer: presentations are intended for educational purposes only and do not replace independent professional judgment. Please refer to the SOA's presentation disclaimer. If you need any technical support at any time, please click on the Help tab for live chat assistance or submit an email to soa@compartners.com. And now it's my great pleasure to introduce Scott Houghton, who will begin today's presentation. Please go ahead, Scott.
Thank you, Sarah, and thanks for everyone watching for joining us today. Our first speaker today is Bill Cember. Bill is a vice president at Prudential Financial in Newark, New Jersey, where he leads the team responsible for Prudential's annuities models for GAAP and stat financials, as well as actuarial projections. Bill has prior experience across life, annuities, and asset management at John Hancock, EY, and Bridgewater Associates. Bill has spoken at other SOA sessions, and he's a volunteer with the SOA, and he's currently the chair of the SOA Technology section. Bill's a graduate of Harvard University. Our second speaker today is Katherine Papillon-Rodrigue. Katherine is an associate director and actuary at AIG in Houston, where her and her team are working to implement LDTI for reinsurance. In the past, Katherine has also worked at Voya, Prudential, and the Hartford. Katherine has spoken at past SOA sessions and webcasts. Katherine is a graduate of Laval University. I'm Scott Houghton. I'm speaking third today. I'm a vice president at Valani Global in Windsor, Connecticut, where I help companies with financial modeling. We're proud to sponsor today's webcast. In the past, I've worked at Oliver Wyman, KPMG, Aon, John Hancock, and Boston Mutual Life. I'm a volunteer with the SOA modeling section, and I've chaired the modeling section in the past. I'm a graduate of Dickinson College. Bill is up first. I'll turn things over to him.
Thanks so much, Scott, and thank you so much, everyone, for taking the time today. Myself, as well as my other co-presenters, are super excited. I'm going to start off today's presentation on TI, and I'm going to focus on variable annuities, specifically around some of the business context for, hey, why do we have to do TI in the first place? So, hey, we're talking about business context, so let's level set with where are we? So back in 2013, the FASB issued an exposure draft with proposed changes to insurance contract accounting. Why was this done? Things are too complicated, and that's going to be a major theme of this presentation. In 2018, ASU 2018 came out, and that was the specific guidance for targeted improvements. And as actuaries, hey, that's what we often care about. That's the specific regulation that we're implementing right now in our models for financial reporting. And where are we right now, or maybe where were we when I put together these slides in 2020, or I guess now it's 2021? Implementation should be well underway for public companies for 1/1/2023 adoption. And there's also the option of 1/1/22 if companies are doing something called early adopting. So I mentioned before that, hey, the whole reason for targeted improvements is that current state GAAP accounting is too complicated. So let me make the case for why that is. And I'm going to start that out with defining, well, what do investors care about when they're looking at earnings for public companies? So in this slide, I'm going to give 3 examples of, hey, what are the sorts of things that our investors are looking for? So the first concept that I want to define is the concept of comparability. And specifically what this refers to is kind of the idea that investors should be able to compare the performance of companies that are in similar business lines. Hey, if company A is selling a variable annuity, company B is selling a variable annuity, it helps if those two companies are accounting under the same framework, so investors can compare their earnings period over period. The next concept that's important for investors is the idea of sustainability. And what this refers to is that changes period over period within an individual company should really reflect that company's operating performance, or any market changes, not accounting mismatches. And specifically, this refers to accounting mismatches between my liabilities and my hedge assets. I want my earnings to actually reflect how that company performed, not idiosyncrasies within the accounting framework. And the final characteristic that investors are looking for in earnings is the idea that the earnings are economic. What that refers to is, hey, the values of my assets or my liabilities on the balance sheet should be somewhat close to their intrinsic value. Hey, it's not going to be perfect. There are other GAAP principles that we want to abide to, but hey, if I have a value of my asset or my liability, we want that to be somewhat close to, hey, that intrinsic value, or what the value would be of that asset or liability if it were sold at the fair market value. So let me drill down a little bit into this concept of fair value, or again, kind of, well, hey, what's the value of that asset or liability theoretically if it were sold on the open market? So the best we can get is this idea of level one. And this basically refers to, hey, if I have an asset or a liability and just, hey, that asset is publicly traded, so I can just pull an unadjusted quote from active markets. A really good example of this is public equity. Hey, let's say my company, we invest in like a mutual fund or an index fund, for example. Well, those securities are publicly traded. There's no discretion for what's the value of that security. I don't need a valuation expert to come up with, hey, what's the value of my S&P ETF, for example. That's the best. And obviously, hey, the insurance liabilities we deal with are a lot more complicated. In particular, our insurance liabilities are not level one. The next best we can get is level two. And what this refers to is, hey, maybe I have an asset or a liability, and there's actually a bespoke calculation that goes into that, but the inputs into that calculation are based on observable public prices. So I think a good example of this is the value of a non-life contingent payout annuity, where, hey, there's no life contingency here, there's minimal actuarial assumptions. So what are the inputs going into that calculation? Those are mainly market-related inputs that are publicly available, and there's not really discretion coming up with those inputs. Again, well, hey, maybe a payout annuity that is like an insurance liability, but most of our insurance liabilities are still going to be more complicated than this. And then the final item here is level three, and this is where most of our insurance liabilities live. In particular, this includes variable annuities, the riders on variable annuities, life insurance, et cetera. And what this refers to is, hey, the value of that asset or liability, there's inputs that go into the calculation of that value that are non-observable to market participants. So, hey, an example here is the value of a life contingent payout annuity, or most insurance liabilities are going to fit into this category. And kind of in the table on the right here is, I think this is either from an SOA or an American Academy of Actuaries practice note on FAS 157, but these are some of the inputs that go into the calculation of riders under FAS 157 for variable annuities. And this just classifies them whether, hey, are they level two or level three. I kind of look at this at the top where most of the market-related inputs are level two. Those are publicly available. There's not that much discretion. This is transparent to the investors. And on the other hand, most of my actuarial or most of my insurance assumptions, these are level three. My lapse assumption, my withdrawal assumption, my mortality assumption. Hey, there's an actuary doing an experience study to come up with that data. This is not publicly available. And for an investor, these are a little bit more black box. Now, I want to connect kind of the definitions I gave in the previous two slides and do a comparison of the three characteristics that I mentioned before and compare them under pre-TI versus post-TI. I'm going to do this pretty high level, and then later in this presentation, I'm going to go through some of these specific actuarial changes happening to variable annuity valuation under TI. So the first concept here is comparability. In pre-TI, kind of this is an issue for investors, specifically kind of the valuation of my rider benefits. There's two possible permissible ways of doing this. Specifically, I can either use FAS 157, which is a fair value framework, or I can use SOP 03-1, which is an insurance accrual model, or really maybe even a third option is using some combination of those two. And in a later slide, I'm going to maybe give some examples of this. Under post-TI, things are much more comparable. All companies are required to use fair value for their rider benefits for variable annuities. So we're using FAS 157. This is much better for investors. Now everything is apples to apples. Now let's look at the concept of sustainability. Specifically, hey, are my earnings sustainable period over period? And do those reflect operating performance or market changes? And under pre-TI, the challenge of this is specifically in SOP 03-1, where, hey, if my liabilities are valued under an insurance accrual model, but my assets are valued at fair value, that's going to create a disconnect period over period. And specifically, when I period over period, there's going to flow through my earnings noise because, hey, my assets and my liabilities are being valued differently. That's going to create earnings volatility, and it's going to create earnings changes that are non-economic. This is not what investors want to see. Post-TI things are also much better from a sustainability perspective, specifically because my liabilities are required to be valued under fair value. There's now a common framework for valuing my hedge assets and my liabilities. Obviously, hey, there's still going to be differences. There's still going to be volatility here, but there's going to be less volatility than if my assets are under fair value, my liabilities are under an insurance accrual model. And then finally, let's look at the concept of, are my earnings economic? And specifically, hey, well, pre-TI, I mentioned there's multiple ways of valuing my liabilities. That doesn't make sense. There's only one intrinsic value, right? There's not multiple values of these liabilities. Both SOP 03-1 and FAS 157, they both can't be right. And under post-TI, hey, we have to use fair value. And at least in my mind, this is me speaking personally, I think FAS 157 is much closer to the economic value of these variable annuity riders. And it's much more economic than SOP 03-1. That being said, it's not perfect. I think it can be argued that certain aspects of FAS 157 are non-economic. A good example of this is the NPR, or net performance risk spread. What this refers to is this is the discount rate that's used to discount back my liabilities. And specifically here, there's a spread here for the possibility that the insurer may default on that liability. What this leads to is I have the same liability, but if that were held under different insurance companies, the value would be different to reflect the different default risk of those two insurance companies. In my mind, me speaking personally, that's non-economic, but that being said, I think this is way, way, way better than under pre-TI. Now that I've talked about a little bit about the backbone for, hey, why do we have these changes as part of targeted improvements? I want to talk about, well, what are some of the business consequences of the pre-TI setup, and what are we seeing right now in the industry? So in this slide, I have some examples of some recent M&A. So back in 2017, MetLife spun off Bright House. 2018, AXA spun off Equitable. Also 2018, Talcott Resolution became an independent equity from the Hartford. What's the key kind of commonality between these three transactions? All three examples are companies of big companies trying to de-risk their balance sheet, decrease their earnings volatility. In particular, what I want to call out here is I think earnings volatility and challenges with GAAP is a contributing factor to some of this M&A. It's not the only factor. In particular, VA with riders, they have heavy capital requirements. That's another big factor. But at least in my mind, some of the challenges with current state GAAP is one of the contributing factors to some of the M&A we've seen in the industry. More recently, 2018, Venerable was formed as an acquisition of Voya's VA closed block. And pretty late last year, Venerable reinsured a significant portion of Equitable's VA block. What's the commonality between these two transactions? Well, Venerable isn't a public company. They're not required to report under GAAP. So this is an example where one could make an argument that, hey, there's challenges with GAAP accounting. So some of these liabilities are moving to private companies. Something very, very timely. I'm really glad that we're doing this presentation today. On my phone here, I have a copy of the Wall Street Journal open up. And one of the articles today is 6-3 partners to acquire life insurance Talcott Resolution for $2 billion. So this is another example that's similar to one of these last three bullet points. This is an example of private investors, private equity acquiring some of these like kind of legacy VA business. I think just quickly quoting the article here, but two quotes that spun out to me. One was that the 2018 Talcott Resolution was one of the trickiest deals put together by financial firms because it involved a risky and volatile type of, Wall Street Journal here using scare quotes, variable annuity, according to industry executives and consultants. Key point here, this stuff is too complicated. And then the article ended. Again, this is the Wall Street Journal, today's Wall Street Journals. Investors have some advantage over publicly traded insurers in holding volatile blocks of business because they don't face quarterly earnings pressures, executives and consultants said. So I think it's really timely. We're talking about M&A, and some of this is happening right now as we speak. I talked about M&A being one possible consequence of, hey, some of the challenges with current state GAAP reporting. let me talk about another consequence. So I mentioned before that, hey, under current state GAAP, there's different ways of accounting for my riders on my variable annuities. So what I have in this table on the left is 5 major sellers of variable annuities. On the top is my company, Prudential Financial. And what it is, I quickly looked at the kind of public financial statements from all 5 of these companies. I tried to figure out, well, how are these companies accounting for their guaranteed minimum withdrawal benefits, or GMWB? So 3 companies, Prudential, Equitable, AIG, at least what I was able to tell looking at their public financial statements is that they're valuing them under fair value. On the other hand, Lincoln Financial, Bright House are using a combination of fair value and SOP 03-1. I'm an actuary. I'm trained to do this stuff. My day-to-day is I lead the modeling at Prudential for these variable annuities. I was trying to figure out, hey, I looked at some of the other companies beyond my own and tried to figure out, well, hey, it's a combination of SOP 03-1 and FAS 157. Like, what the heck does that mean? And I wasn't able to figure this out. This is my day job. I'm a pretty smart guy. Hey, if I'm not able to figure this out, I have this, it's big, bold, highlighted in yellow. How the heck are ordinary investors supposed to understand this? What's another consequence of this? Well, I talked about M&A earlier. Well, all 5 of these companies are using non-GAAP financial measures in addition to GAAP reporting. And I'm going to talk a little bit about that in the next slide. So what are non-GAAP financial measures? Well, these are basically custom-defined measures of often operating performance that are reported in addition to GAAP accounting. What are some of the goals of this? Well, one is, hey, a company may want to remove some of the mismatches between their assets and their liabilities to kind of maybe decrease some of their earnings volatility or make their earnings more economic. Companies may want to remove items that are not expected to recur in the future. And yeah, I mentioned before, addressing some of the non-economic nature of certain GAAP items. On the table on the right, well, what are some examples of this? Well, these are kind of, I looked at those 5 companies I mentioned in the previous slide, looked at their public financial statements and just kind of description of their adjusted measures. I think one company I looked at was stripping out realized gain losses associated with the changes on their hedge assets. Another was stripping out the changes in reserves from benefit ratio unlocking. Another was stripping out GMIB fees and costs. One company was stripping out COVID-19 impacts. I think this last example here, this is removing something that's not expected to occur in the future. What are some of the issues with this? Well, the first issue is, again, well, this isn't really that transparent to public investors. Again, I'm a trained actuary. I do this as a living. I had trouble understanding this stuff based on just the publicly available financial disclosures. Another big issue, hey, I talked about the concept of comparability earlier in this presentation. Hey, we think, hey, maybe we have some issues in GAAP. Look at this previous slide. Well, for GMWBs, I was able to, hey, some are fair value, some are using a combination of SOP 03-1 and FAS 157. But I look at my non-GAAP financial measures, every company is doing their own thing. This is not comparable at all. This is like a big issue for investors. And then the final issue here is, hey, well, GAAP, like, this is a regulation. It really doesn't change period over period. This is a whole webcast on targeted improvements, which is a change to kind of the accounting framework. This is a really big deal whenever kind of the accounting methodology changes for GAAP. For non-GAAP financial measures, there's a lot more discretion involved, and management, obviously they have to disclose this, but there's the ability for management to change methodology period over period. So, hey, this can cause problems. Hey, do investors actually trust these earnings? Is it transparent to investors? And I think one of the consequences, hey, you look at some of these financial measures, this is a real black box to investors. They don't necessarily trust it. And because of this, well, if I look at the PE ratios for many companies, PE ratios are low for VA writers. I think a really good example of this is kind of, you can look at maybe some of the companies that are very highly concentrated in VAs. Look at Equitable. I think their PE ratio, and this is me speaking off the top of my head, I think it's something like 3, 4, 5. That's a low number. That includes their stake in a publicly traded asset manager, AllianceBernstein. You strip out that AllianceBernstein portion and you get a very low PE ratio. Another example here is kind of that transaction I mentioned before with Equitable reinsuring a large portion of their legacy VAs to Venerable. There was a big stock price increase when that happened. When that was publicly announced, I think the stock price jumped up around 10% that day. So investors really don't trust these earnings. They don't know what's going into them. There's afraid, hey, there might be these like hidden surprises, quote unquote. And because of this, there's very low PE ratios that are applied to VA writers. And obviously, hey, this is a problem for companies in the industry. So now I think I've talked a lot about the business context. Why are we doing targeted improvements? Hey, well, the GAAP accounting, it's not very transparent. It's a big black box to investors. So this is the business portion of the presentation. So now, hey, this is an SOA presentation. Let's talk about some of the actuarial changes. So the first change here, DAC. What's the change? Well, pre-TI, current state, DAC is amortized over expected gross profits. Post-TI, DAC is amortized over the expected life of the contract. Why are we doing this? Well, this is a much simpler way of amortizing my DAC. This increases my understandability for investors. It decreases some of that black box nature. I mentioned level 1, level 2, level 3 inputs here. Well, expected gross profits, hey, that's level 3. And if maybe theoretically there's something called level 4, this would probably be level 4. This is a real expected gross profits is just like a total black box to investors. Even though maybe as actuaries we can understand this, but this is a black box to investors. What are some of the consequences of this? Well, I think the first is, hey, this is going to be a more easily predictable expense pattern for investors that will hopefully reduce earnings volatility. That's a good thing. Another thing here, DAC amortization is no longer dependent on investment or underwriting results. Also, this will hopefully reduce earnings volatility. The next change, I talked about this a lot previously in the presentation, but my market risk benefits or how I'm reserving for my riders. I mentioned this earlier, pre-TI, you have to value your riders at either fair value or insurance accrual, i.e. either FAS 157 or SOP 03-1. Post-TI, one method, we're using FAS 157 for all companies are required to do this. This improves comparability, and also me speaking personally, I think this improves this is more economic. What are the consequences of this? Well, a greater consistency in the measurement of my liabilities and my hedge assets. Hopefully that will decrease earnings volatility. What are companies going to do about this? Well, hey, there's a lot of challenges in current state GAAP. One consequence of this is that companies have their own non-GAAP financial measures. Do companies actually need non-GAAP financial measures once TI goes live? I think that's a pretty big open question. I think we'll see. Obviously, I think we don't have enough information. Companies haven't made their decisions yet, but at least for me, that's a pretty that'll be pretty interesting to see. Do we even need these adjusted operating measures once TI goes live? And then a final question here. Hey, if we're changing how our liabilities are measured, are companies going to change their hedge strategy? In particular, hey, if my liabilities are measured at fair value, my assets are measured at fair value, that works really well if I'm 100% hedged. But if I'm not 100% hedged, well, that's going to flow through earnings. So are companies going to hedge more? Are companies going to start hedging to GAAP? There are obviously many different things, targets you can hedge to. You can hedge to GAAP. You can hedge to your adjusted earnings. You can hedge to stat capital. Some companies have their own maybe economic framework of measuring liabilities. You might hedge to that. So this is a hard problem. There's multiple things you want to balance, and depending on what you're hedging to, it gives a different result. But in particular, hey, given some of these changes in GAAP, are companies going to change their hedge strategy? And then the final item I want to talk through, and this is, I think, the last slide in the presentation, is, well, enhanced disclosure items. So in particular, in addition to, hey, some of the changes in methodology, target improvements requires for my variable annuities enhanced disclosures along things such as quarterly liability roll forwards, actual to expected experience, and additional information around my inputs, assumptions, and methods. Hey, let's make those level 3 inputs less black box. Why are we doing this? Increasing transparency, making results more comparable. Hey, every company is doing experience studies. Every company is coming up with mortality rates, but from the investor perspective, this is a black box. So I think the goal here is, hey, well, let's actually maybe give some more detail around this and make it a little bit less of a black box. What are the consequences of this? Well, none of this stuff is live yet. So is this actually going to be useful to investors? I sure as heck hope so. I know at Prudential, we're spending a lot of time trying to program in and come up with a process to do these disclosure items. So I'm personally hoping this is going to be useful to investors. Kind of from a company perspective, is this going to reduce some of that complexity stigma around variable annuities? I quoted from that Wall Street Journal before, variable annuities had scare quotes around them. This stuff is really, really complex. Is this going to reduce that complexity? Will PE ratios improve? I think that's something that many, many companies are hoping for. And hey, what are some other consequences? Hey, if PE ratios improve, will that change some of the M&A activity? I think the short answer is, at least, I don't know. I don't think anyone knows this, but I think these are some of the questions that the industry is going to have to answer over the next couple of years. So with that, I want to thank everyone for taking the time, and I'm going to hand things off to Katherine.
Thank you, Bill. That was very informative. So in the second segment of this presentation, I'm going to talk to you about reinsurance. I'm going to structure my presentation into really three parts. What is changing? What can we do now? And what does our process flow look like in a LDTI? So jumping in, what is changing? Well, from a regulatory standpoint, the simple answer is nothing. However, that hasn't stopped the industry from asking questions. There is an expert panel being led and taking questions from the industry to tackle and try to provide guidance. This has been led by the American Institute of CPAs. And at this point, the main questions that have come up on the assumed side relate around three items. The first is what reinsurance contract enter date should be used. The second revolves around the unit of accounting for fixed non-cancelable contracts and the unit of accounting for reinsurance contracts where multiple product lines are contained. Actually, last Friday, to Bill's point, we had planned this for 2020, but with the deferral of time, we do have some additional guidance. So as of Friday, they published an exposure draft that's open to comments until April 15th on these three questions. Their current proposal is very general. The overarching guidance is that assumed reinsurance contracts should be reserved for and accounted for the same way you would do with a direct issued policy. For items like the third, where multiple product coverages are in the same reinsurance contracts, they're providing guidance to use professional judgment to look at current aggregation rule and cohorting among your company. They also make reference to a look-through approach of using the direct issued date of the policy and reserving accordingly. So if we pivot now to the seated, there is also a number of items that have come up. However, they have started tackling these questions earlier and a little further along. So the first, the key questions have been around reinsurance recoverability and cost of reinsurance, whether the premium ratios should be capped and floored. The second is for in-force transactions, determining which liabilities should you be including in order to be able to determine the appropriate discount rate. The third is there a accounting policy change that would allow you to include your cost of reinsurance in loss recognition testing? And last but not least, for the market risk benefits that Bill gave us, there's a lot of questions around what portion of the fees should be reflected in the calculation. Is it the fees of the total contract or only the piece that is reinsured? So at this point, the first three items have been addressed and now are officially available in the final version that they have published. The kind of proposition where the guidance have landed for the first items is that capping and flooring of the cost of reinsurance should continue. However, they do not go into any great length or details around how to actually apply it. For in-force transactions, the guidance again is relatively broad and provides makes you look at whether what the discount rate is prior to transition and what is it going to be in the future. And for the third, they have taken a strong position in saying that the accounting practice that was done prior to LDTI should continue in a post-LDTI. That means that if cost of reinsurance was included in loss recognition in a post-LDTI, in a pre-LDTI, that would continue in post-LDTI and vice versa. For additional details about these developments, feel free to reference the website below. And if you want, comment as exposure drafts become available. So now I'm going to pivot to what can we do now? So though nothing has changed under the reinsurance guidance, we are still binded by the same rules. The rules today are relatively broad and simple. We are to value reinsurance liabilities in line with their direct liability. If there is any offset, if a reinsurance transaction has any offset to acquisition costs, we should look to hold a contract, and any gain or loss due to a reinsurance transaction should be recognized over the duration of the contract. So that being said, those guiding principles continue. However, we must go back and look at the approximations that we may have made in a pre-LDTI environment. For example, something may have worked with the current accounting, but now under the new LDTI framework is no longer an appropriate approximation. We will need to relook at those approximations, make sure that they are not materially different than a first principle approach, and also make sure that our auditors are comfortable and that we can prove that it is not materially different. There is also other regulations that use similar principle as LDTI. For example, we can look at what is done on a Canadian GAAP or IFRS 17 to get an idea of what similar transparent reporting bases are handling some of these issues. And last but not least, as Bill mentioned, the disclosures around LDTI have changed significantly. However, for reinsurance, they remain very basic. It is only a single line in the file, and you must think and step back and ask yourself, what kind of information would you need to explain results, to get management comfortable with results, and if you would want to show that additional information. Again, these considerations will help you determine the best way to implement LDTI on a reinsurance framework for yourself. So now that we've seen that LDTI has not changed a whole lot from a reinsurance perspective, there's definitely a lot of considerations that go into it. So we'll move on to thinking about how will our process flow look in a post-LDTI world. One thing that LDTI will definitely push everyone to do is to relook at their valuation process from start to finish. There are many different factors as to the strategy a company may take to implement an LDTI. Some of the key factors that will kind of drive your decision is whether you've decided to early adopt or use regular adoption and the restated financials for the periods associated with that adoption. There's also a dependency on what your current company's platforms are and processes. Do they need to be fully overhauled? Or can we move with a day one implementation and move towards a long-term strategy? Is a company willing to make a financial investments to modernize systems? Or do they have the human capital to be able to execute those changes? So those are kind of the key factors of what your process will look like at the beginning. When we go into evaluating your current infrastructure, very quickly, we can go down a lot of different rabbit holes. First off, the data. Many people have not modeled reinsurance in the past, so you must look at the data that is available, the data that you would need, and if there are any gaps, how will you obtain that data? If it's unavailable to obtain that data, is there a good approximation or method that will satisfy your company and the SO and our professional duties to make sure that the model has integrity with respect of what is coming into the model? We must also look at the best way to manipulate this volume of data. Oftentimes, a reinsurance treaty has a lot of rates and values, tables. It might not be formatted in the right way. How are you making sure that the data is coming into your model correctly? And so very quickly, just the undertaking of preparing the data can be quite significant. Next is looking at your modeling platform. Does your current modeling platform give you the ability to expand it to an LDTI framework? Maybe yes, maybe no. Is your modeling platform able to integrate both the direct and the reinsurance liabilities? And maybe that's not important, but you may want to think of the implications it has when it comes to controls, the risk it introduces, and the ease of getting results accurate in a timely manner. And nonetheless, every modeling platform has its limitations. Some of them are bigger than others, and so you must consider all of these aspects to come up with a final strategy. As you move on to controls, in order to give our shareholders accurate and timely material, we need to understand the risks involved in our processes. So you will need to look and see if there are new risks introduced. So if you now have a non-integrated model, do your ceded and direct cash flows reconcile? Do you have the same status? And maybe that this task seems okay at first, but as the number of policies grows, can you still do it efficiently? There may be controls that are redundant. And so you will need to look at that framework and make sure that everything continues to be as efficient and timely as possible. And last but not least, you will need to get this information out to stakeholders in the form of disclosures, and oftentimes people will use a ledger. If you're looking to use your ledger to automate disclosures, you need to make sure that it can contain the information you need to roll it up in an automated way. If that's not an option, is there other products available, or are you going to develop a homegrown solution? So as you can see, though none of the guidance in reinsurance has significantly changed, there is definitely a lot of aspects that are impacted that are indirectly impacting the reinsurance from the simple fact that the direct valuation is changing. And so in order to have a successful implementation, I encourage you all to start thinking of how to change your reinsurance accounting to be able to implement this and be ready day one. And now I will turn it over to Scott, who will walk us through assumption setting under LDTI.
Thank you, Katherine. I'm going to talk about setting assumptions and the process for setting assumptions for long duration products, including term life insurance, whole life, long-term care, and disability income. So this is the actual text from the accounting standard update, so the actual guidance that's on the discount rate. I'm going to draw attention to a couple items here, and we can unpack this a little bit. In the summary of the accounting standard update, the goals are to remove company-specific items and remove judgment. There's some terminology on the slide here. The first paragraph mentions upper medium grade, low credit risk, fixed income instruments. If you go to the Moody's Investor Services website and you look up a single A rated bond, it uses those same exact terms, upper medium grade and low credit risk. So there's a consensus to use a single A rated bond yield for a discount rate. So it no longer matters what a company actually invests in. If a company buys a grade below single A, Baa in Moody's or triple B in the S&P ratings, that doesn't matter. We still use a single A rated bond yield to discount. So the level of credit risk to reflect in the discount rate is basically prescribed. If we look at the middle paragraph up on the slide here, the duration is prescribed too. The paragraph says to use the duration characteristics of the liability. So say if a company invests in assets, longer than the term of their liabilities to take some duration risk, and in an upward sloping yield curve, they could pick up some extra yield. LDTI doesn't actually stop anyone from actually taking that duration risk, but it does stop us from using the extra incremental yield that comes from that duration mismatch in the discount rate. Now, the third paragraph says to maximize the use of observable inputs and minimize the use of unobservable inputs. The discount rate can be a single A, yield curve, meaning, there's a term structure over time, so a different yield depending on maturity, or it can be a single equivalent rate. The yield curve has a slight advantage if the liability duration is different than what we expect, that the methodology still holds together. There's not a right answer as to what period or curve or rate to use. We could average rates over the entire reporting period, or we could use rates as of the end of the monthly or quarterly reporting period. My own opinion, I happen to think the balance sheet is a snapshot in time. So if a company reports quarterly, the Q1 balance sheet is a snapshot at March 31st. So the March 31st single A yield curve is the right curve to use. Now I realize this, creates some logistical challenges and other issues, right? It's generally not available until business day one in the reporting cycle and can be challenging for some companies to implement. So I've talked about credit risk and duration risk are prescribed. Now, I've worked as a consultant for a large number of companies, and I've also worked in the past as an auditor. There's a wide range of actuarial practice out there. So I'm going to ask you listeners, have any of you out there ever worked with somebody who sets assumptions a little aggressively? Well, let's think of a name. Let's call these actuaries line challengers, right? They don't want to cross the line and have anyone see that their foot's on the wrong side of the line, but they might go right up to close to the line and trying to stand this far away from it. If your line challengers are out there viewing the webcast today, you probably know who you are. If your assumption setting has the potential to be used as one of those case studies in professionalism at an SOA meeting where the attendees are split 50-50 in the poll as to whether the actuary acted properly, that could be an indication. If your company uses captives insurers, that's very common. But if the captives themselves have captives, well, then you might be a line challenger. For your line challengers out there, the interesting piece is that there are other risks on the asset side of the balance sheet besides credit risk and duration risk that are kind of prescribed in the guidance. There's liquidity risk, there's prepayment risk, and convexity risk that are not prescribed. So say there is a specific liability characteristic, like you have a liability that's not liquid, like a traditional long-term care without doesn't have a cash surrender benefit. That kind of comes to mind. The policyholder doesn't have a great deal of liquidity. If this liquidity is backed with an asset that's less liquid, there might be some room there to reflect the illiquidity in the discount rate. Now, the issue with illiquid assets is that, well, they're hard to get market value quotes on. The guidance on the slide before this one said to minimize the use of unobservable inputs. But there are brokers out there that specialize in private placement bonds and mortgages, and it's possible to, there are rating agencies that'll rate these instruments and give them a comparable rating to single A, and it is possible to construct a yield curve with the information and quotes that they have. Another thing we want to think about here is that with U.S. Treasuries, if we create a yield curve with maturity on the X or horizontal axis and the yield on the Y or vertical axis, we get a curve that's usually upward sloping, but not all the time. For insurance company size transactions, the yields for a given maturity, they fall in a given range that's very narrow. If you see treasury quotes more than a few basis points apart, it would indicate that there's two prices for the same asset in the financial markets at the same time, and that's unlikely. It doesn't happen often. A more likely explanation is that the data you have isn't perfect. So usually treasury curves fall on a thin line. If we look at single A rated bonds, we don't get that result. We don't get that same result. A little bit of a problem here for us to solve. How do we construct a yield curve or get a discount rate out of this, right? Give you some background information on this graph, right? I've got the yield on the y-axis and the term to maturity of the bond on the X or the horizontal axis. One of the validation steps I use when I model an asset portfolio is to model the term to maturity of the asset on the x-axis, just like, and the yield on the y-axis, just like this. And this is the market yield, the yield taking the current market value and on holding the bond to maturity and looking at the cash flows. What yield do you get? And we plot every observation as a dot on the graph, or another symbol, an asterisk or something like that. This is called like an XY or a scatter plot. And what I would do is do every different bond of every different bond rating, and the different bond ratings I would represent as different colors. So what you get is since different bond ratings affect the yield, the riskier bonds get a higher yield. What you get when you do this with all the bonds is a range. If you represent each bond rating with a color, you get a rainbow pattern, right? So the different color bands represent different bond ratings. And if there's outliers, we can see colored spots that are out of place. They're in the wrong band, right? We can see some isolated colored spots, just like on this graph. You can see some dots that are above or below the rest of them. There's a couple things we can do to if we see those outliers, we can try to dig into things a little bit and validate the model. Now, this graph is the same concept of what I'm talking about, except there's only one bond rating. So, sadly, there's only one color on the graph today. But the issue is that unlike a treasury, it's not a line. It's this fuzzy band that we see up here, and we want to use observable input. Remember, so is a single A rated bond observable? Well, the answer is yes. Sort of, right? What causes the width of this? Well, single A covers a range of credit risk, right? So there are sub ratings, right? They could be a bond could be rated A1, A2, or A3, or different rating agency, A+ or A-, right? There's also other risks besides the duration and the credit rating that we've talked about already. Now, you line challengers out there, you can't just take a pen and connect the dots along the top of the curve. Right. The rest of us, right, if you're not a line challenger, you can't just draw a line down the middle of the curve either, right? This process is subject, this is GAAP now. The process is subject to controls, and it needs to be consistent each quarter and each reporting period. So we can talk a little more about how to get the line later, but we could make a justification for using something closer to the top of the range I've mentioned if there's a liability characteristic like liquidity. The key words we want to remember in the guidance are just reliable information and observable input. What I haven't talked about today, because there's a great deal published about it already, and there's a lot of good literature, actuarial literature about it already, is what to do if liabilities are longer than the term for available assets that are observable, right? So the right side of my graph cuts off at 30 years. Well, there's some white space off to the right. What if the liability has cash flows out in that period? And there are a lot of good published methods to address that. So I haven't talked about it today. Now, it's necessary to recalculate the discount rate each reporting period. And we need to do more than one run for the discount rates. We do a run using the original discount rates, then we do a run using the current rate. And the difference in that liability doesn't flow through directly to the top of the income statement. It goes below the line to other comprehensive income. So the change in accumulated other comprehensive income is changed to reflect the difference of the two results. So this slide represents a typical process a company might go through to set the discount rate each period. The first step is to collect and analyze the observable input. It might look like the graph we had up on the prior slide. If it does look like that, the next step is to fit, smooth, and develop the observed yield curve or rate. We need a process to take that blotchy band of blue dots from the prior slide and develop an assumption, either an exponential curve fitting or a nonlinear regression. Once that's developed, a company can create and follow a process for review, recommendation, approval, and finalization. Assumptions that are not the discount rate are called cash flow projection assumptions under LDTI. These assumptions are all based on estimates of future experience. And if we have changes to these under LDTI, these go above the line and directly impact the income for the current period. Now, the Accounting Standard Update 2018-12 that LDTI, it's 193 pages long, but it doesn't give us a lot of guidance for assumptions. So for our mortality, we do include mortality improvement and future mortality improvement to the extent it's part of the estimate for future experience. Morbidity and terminations, there are some breakdowns given that the assumptions can be grouped by. Like the guidance gives examples that you can break down terminations by plan, issue year, premium mode, and other factors, and it also says you can do that, or you can use an aggregate rate. For morbidity, the guidance is a little bit more prescriptive. It says to vary the assumption by contract type, class, gender, age, and benefit period. So it's a little more prescriptive for morbidity. Also for terminations and lapses, products that don't have a cash surrender value should still have a termination rate. That includes lapse supported products. There are a couple of big differences from current treatment. For expenses, the treatment is different than current GAAP. So the only expenses included in the liability for future policyholder benefits are the ones related to benefit administration, like expenses related to processing a surrender or a claim settlement. Maintenance expenses are expensed under LDTI. All of these assumptions on the slide together determine the. So under LDTI, our process needs to change. Previously, assumptions were locked in. The process for getting best estimate assumptions was only used for loss recognition testing. And in my view, my experience, it was not subject to a high level of scrutiny. Under TI, it's kind of like we're unlocking every period. We need a formal process to set the assumptions. And again, I see a wide range of actuarial practice. Study on, kind of a spreadsheet with a couple numbers in it, and it might be hard for somebody outside the company to follow, or someone not familiar with the spreadsheet to follow. But then I see some experience studies done in a very formal written study. I've seen company studies that that rival what the SOA publishes for an industry research report, right? So if your experience studies are done in a spreadsheet and not at least a formal written study, maybe they need to move a little bit in that direction. Under LDTI, there should be something that somebody from outside your organization, like an external auditor, could pick up and understand and follow the process. There's one key piece of guidance that says to review, and if there is a change, update the assumptions used to measure cash flows at least annually. Now that one word right there, at the beginning of the quote, review, well, that means a lot of work. It means we need to have a view of our assumptions, how our experience the assumptions, and how the experience compares to what's, in how it compares to that are in the models now, and how, basically how it compares. For a company, it probably means they need to update their experience studies regularly, a minimum of annually on the standard, but they also need a view as to how their emerging experience from each reporting period compares to the assumptions in the models used to project future benefits for reserves. The minimum amount of work that we need to do for a company of any size is to compare our actual experience to expected experience. So there are disclosures that require this. We talked about lapses in morbidity grouping of assumptions by liability characteristic. The breakdown on this slide is a different type of breakdown. These are breakdowns of actual versus expected. What it means for companies is that assumptions are going to be much more granular than they were before. The actual and expected experience need to be available at the levels that DAC is grouped and the levels at which reserves are calculated. There's a requirement that the DAC balance be reduced if actual terminations exceed expected terminations. There are also disclosures that require the comparisons as well. This is the type of information needed, or one way of complying with the new disclosure requirements. Let's pretend it's April 2023 and we are doing reporting under LDTI. This is for a term life product. This is a hypothetical for Q1 2023, so that there are 2022 issues here. It's a newer product with recent underwriting and low mortality. Now, I use the word cohort to represent a grouping. The new terminology in LDTI for cohort is the level of aggregation at which reserves are calculated. I can't quite fit that in the box in the slide, so I'll stick with cohort. Anyway, each row represents a level of aggregation at which reserves are calculated. The top left portion has starting values, policy count, face amount, and premium. If I look at the top table of numbers in the total row, there's 111,126 policies at year-end 2022. When my reporting period for Q1 2023 starts, the average policy size is about a $250,000 face amount. The face amount is in millions. The total face amount is just under 28 billion. And my total premium is 16.67 million annually. I'm showing that as an annualized premium measure, as an in-force. It's an in-force statistic and not a cash flow item. The top right side shows expected lapses and deaths. The bottom left shows the actual ending amounts. The bottom right shows the actual lapses and actual deaths. So there's a relatively fine level of granularity to split the experience into, the actual experience and the expected experience. There's some work to do on both the IT side and the actuarial side to be able to produce this. This is a piece of the new disclosures needed. It is not complete. There's other information about these policies that need to be disclosed as well. The expected lapses and deaths might be a little easier than it looks. Most actuarial software will produce a policy exhibit and an equivalent exhibit for face amount and premium. There's a starting amount that rolls forward, then it has decrements, then it shows the ending amount. Well, software gets the expected decrements by applying terminations and mortality assumptions. So if you put the GAAP LDTI reserve assumptions into the software and run a projection, the software will calculate the expected decrements for us. The guidance on a prior slide said to review assumptions at least annually, and if there's a change, to update them. Well, this is a block of relatively new term insurance. I'm going to round the numbers for my example, but the expected deaths here are 22.91 out of 111,000 policies. So my QX is about 0.2 deaths per thousand. Excuse me. My P, or probability of survival, is 0.9998. So the mean is 22.91, the expected number of deaths. The standard deviation, if you remember our binomial distribution, the square root of NPQ, it's approximately 5. So with 24 actual claims during this period, I'm right in the thick part of the distribution, really right where it should be. And there's not enough information up here for me to change my assumption. If there is a mortality study that led to the mortality in the model that leads to the model projecting the 22.91, and we updated it with this new data, maybe not every quarter due to the low materiality of this experience, but if we did this annually, do the estimates from the study change at all? That's what we need to think about. The accounting standard update gives an example where there's a small amount of deviation and the company decides not to update their assumption. Then the example continues and they turn out to be wrong 3 years in a row, and then they do decide to update the assumption. Now you might notice here that the level of observed terminations, especially the deaths with 24 actual, don't give us a high level of statistical credibility. Even if we extrapolated this to a full year, we'd have something like 100. It's still not a high level, but we still need to review company experience to determine if the difference between expected and actual is due to the assumption, maybe needing to be revised, or due to a statistical fluctuation. We'll discuss that a little bit coming up. If you haven't noticed by now, well, if you're setting assumptions under LDTI, you have the opportunity to learn or relearn some mathematical processes. These are the kind of tools I like to keep around. Continuing from our discussion on the previous slide, we had 24 claims. Standard deviation was 5. We need more than 1 quarter of experience to really draw any type of conclusions about mortality. The credibility theory that's published in actuarial literature is in the context of mortality table construction. It's not about revising assumptions for LDTI. So we really need to understand that a bit and revise it and adopt it for our own purposes. That context of credibility there is, a little bit different. We want to be building a mortality table. You want to be able to say things like mortality will be within 5% of the value predicted in the table 95% of the time. Well, if we call that full statistical credibility, a 95% chance of being within 5%, it depends on the actual numbers and the mortality rates, but we need about 1,500 claims, observed actual claims to get there, right? And that context is not the right one to use for LDTI. If I set a mortality assumption and the emerging experience tells me that I'm 95% sure my mortality is wrong, am I going to change my assumption? Of course I am, right? But what if I'm 51% sure that it's wrong? The line challengers are all up there. They're all up there saying, no way. There's almost a 50% chance it's right. I'll try to make 2 key points here, right? I don't need 1,500 claims to know that I have a 51% chance of being wrong. I can get a higher comfort level, a higher confidence level that my assumption needs to be revised by just observing a small deviation from expected. If you actually work through the numbers and work through the credibility theory. Second point is for us to establish a context for setting assumptions now and set up a process. We could say, like for mortality, that like we've been talking about, a process might, at a high level, it would look like, we could say that, hey, we're going to look at this historical period and define what this historical period is, and whether it includes the current quarter or whether you do it a quarter in arrears to save time at when you're doing your you're reporting for the current period, and I shouldn't say quarter, whatever your reporting period is, quarterly or monthly. So we're going to look at this historical period. We're going to pool these products together. We're going to calculate our standard normal z-score, and we're going to change our mortality assumption if the z-score is outside of a certain predefined range, right? So if we set that as a context for setting assumptions in advance, then it's easy to figure out what we're going to do when we actually get to 2023 and we're reporting under LDTI. We want to put a process in place now and try fitting it for past data to develop these parameters, and if necessary, negotiate with the auditors before the date we move to LDTI. There's some other types of high-level math. For the discount rate, the single A yield curve is usually not linear. It's a curve. So to make a line out of all those dots in the graph I showed you earlier, a curved line, we can't use linear regression that we all learned taking actuarial exams. We need to use a more advanced formula fitting technique. Polynomial regression is probably the most straightforward way to have a repeatable process that'll give us an assumption we can use. There's other methods like fitting it to an exponential curve, but it's something we want to think about well before our implementation of this standard update. I mentioned rejection tests on this slide. Now, I'm not talking about what some of you may remember, hypothesis testing, where we can accept or reject a null hypothesis and be 95% sure. I'm talking about if we have that slide full of dots that shows the single A rated curve, and we have an observation that's an outlier. So say we're setting our discount rate and looking at the XY values for a yield curve. We're looking at observed values, and it looks something like the band of dots, and we see a dot that's way above or worse, way below the others, and we think it'll influence our nonlinear regression curve fitting. One way to deal with that is to do some research on it, right? Go see where the bond quote came from. Maybe the market value was stale that went into the yield and not really applicable to that period. So you could try to research it that way, and if it turns out to be unreliable, we're not supposed to, we're only supposed to use reliable information. The standard says, so we could throw it out. But maybe you don't have the time to chase down the investment department, on business day 2 or whenever you're looking at this curve, right? There's another way. There's a statistical test called a rejection test that allows us with some specified level or prescribed confidence to remove an outlying observation while we're doing the curve fitting. Remember, the accounting standard update says to use reliable information. If we're 99% sure or 95% sure an observation is bad, then it's easy to say it's not reliable, and we're gonna throw it out. And there are published tests that allow us, methods that allow us to do that. The point I can make here is that there are these tools and others. I put these into the framework for LDTI in advance. Anyone ever have a plumber, electrician, or repair person come to their residence? Well, they've got a big toolbox with them and more tools in their vehicle. And looking at them can actually help us with LDTI, right? They know that it's a lot better to have a tool with them and not need it than to need it and not have it. If we need more data to set or perform our annual review of experience under LDTI, so more than we have, right? For the term product I had, there wasn't enough to be credible. So we need more data. Company experience is probably the most valuable. In actuaries, we already know we can look at similar products, similar underwriting standards to try to get experience for a product we may be looking at. But certainly anything we can get within the company has the most value to it. If we reinsure products, reinsurers have access to larger pools of information. They can help companies determine if their company experience is the result of a larger trend, or maybe just something that's unique to their company, whether it's part of a larger trend. There's also a large amount of industry data available, at the SOA and other organizations like LOMA and LIMRA and other research institutions. So. This slide, it compares assumption setting under three bases. The first row is, accounting standard 944-60-25-9. The key number there is 60. This is the standard that's formally known as FAS 60, and it's codified. So it's GAAP before LDTI. We use the best estimate assumptions plus a pad. They're locked in with an asterisk, and the asterisk means they're locked in unless your projection falls apart, and things aren't, DAC's not recoverable, or there's other issues in the projection, and then they're unlocked. The second row is statutory valuation, so U.S. statutory valuation for life products under VM20, and the third row is LDTI. VM20 uses anticipated experience, which is another way to say best estimate. Plus there's a separate margin added to VM20, so it's anticipated experience plus a margin. LDTI just uses best estimate. So, question is, should our best estimates for LDTI and VM20 be the same? Well, usually yes. VM20 has prescribed experience periods for things like mortality and more things prescribed overall. So there could be a difference if the company views, one of the rules of VM20 with it's not being consistent with their true view of estimated future experience. So there's room for differences between those two sets of best estimates, as long as we understand why those differences arise and we're able to explain why why there are differences. One difference for LDTI and VM20 is for mortality. So under VM20, no future mortality improvement is allowed, and under LDTI, it would be included to the extent it's part of the view as of future experience. And LDTI requires an annual review of assumptions, and VM20 only requires a view of mortality every 3 years. So under LDTI, our assumption setting process needs to look different. What needs to change? Our experience studies need to be more granular. There are more disclosures. We need to show actual versus expected. Our processes for assumption setting and review need to be consistent from period to period. When we need to formalize the process for assumption review and sign off, and formally state the criteria for approval and moving to final values. Oh, and there needs to be controls around the entire process. We need to apply controls to the data setting process. Excuse me. Data files, collection, and validation. Our experience studies should follow actuarial standards and be peer reviewed. The process for assumption review and recommendations needs to be documented. The question is, who does the review? What specific items do they check? Who does the review as an alternative if the person who's supposed to do the review is out of the office, right? We need to think about all of this. And the approval process needs to be documented and have controls applied to it. So if the process for our assumption approval now is to have the VP and actuary review and sign off, well, we need to document that. We need to interview that person, get them to write down the criteria they use, put this in the documentation. Think about what to do if they're unavailable, if there's a job vacancy or illness, whatever reason, right? Who's their successor in the event that they're not in the office to be able to do that. How does the new way of setting assumptions impact our products? Well, I'll apologize lightly for the subtitle on this slide, but how does long duration targeted improvements impact long-term disability income, long-term care insurance, and life products? Bill had a point up on one of his slides that the value of assets and liabilities should reflect their intrinsic value. There was a time when the discount rate on the liabilities would be locked, with an asterisk, and the assets could be marked as held to maturity. Under that held to maturity designation, the yield would be the same over the life of the asset. The investment income would be uniform. If yields on renewal premiums didn't change significantly and there was not a need to unlock the interest assumption on the liability side, the investment income was very predictable. Well, LDTI changes all of that, right? Now the liability side is marked to market because the cash flows are discounted with the current single A rate yield curve. Now, if we wanted to reduce the volatility in accumulated other comprehensive income as much as possible, that may or may not be the goal, but for the moment, let's say it is. The best way to do that is to buy single A rated bonds that have the same duration as the liability, hold all the assets as available for sale, so they're marked to market just like the liabilities. That way, any change in the discount rate impacts the bond portfolio and the liabilities the same way, and this minimizes the volatility. So under LDTI, book value accounting is gone. So yields are kind of low right now. If companies take some duration risk and they invest long to try to pick up some yield, well, that adds volatility, right? Because now there would be a duration mismatch between the assets and the liabilities, right? That would, and a shift in rates or non-parallel shift of the yield curve could just throw a difference into your other accumulated OCI. Well, will companies end up taking less duration risk to reduce volatility under LDTI? Well, that's a good question, right? For disability income, if the product has a level premium and a reserve builds up, then active life reserves are impacted by LDTI. Claim reserves or disabled life reserves are classified as short-term generally by most companies, so they're not impacted by LDTI. On a group product where the premium could be increased by the insurer annually or set by the insurer, this is considered a short duration product. It's not impacted by LDTI. For long-term care insurance, active life reserves are treated the same as long duration, and the same guidance for LDTI that I've been talking about for the discount rates and the assumptions applies. Claim reserves for policies that have a limited benefit period are also usually classified as short-term, so they're not impacted. For a lifetime benefit, claim reserves for long-term care have characteristics of both short and long-term. So that's something long-term care writers need to work through. So the first step is to classify the liability and then apply the appropriate guidance. Interest and morbidity for long-term care are, the assumptions sometimes actuaries have been, historically, incorrect about for some in-force blocks of long-term care. So not only does LTC have a benefit that kicks in if someone needs care over a long-term period, that gives its product its name, but it's also long-term in other ways. It's long-term because the benefits occur a long time into the future. So that single A rated yield doesn't need to move or shift very much to create a large amount of movement in the discounted value of benefits. So the accumulated other comprehensive income can move a great deal with a small movement in interest rates. As some of Bill's material alluded to, I think this new volatility will continue to drive consolidation in the industry. So this is the end of our formal presentation. We've got some time for questions. I believe your screens allow you to submit questions. I see we have a question up on FAS 157 and SOP 03-1. Bill, would you mind taking that and please reread the question to the audience? I've got to work on my view here so I can get the questions up.
Sure, yeah, I can take that, Scott. So the question is, I don't think FAS 157 versus SOP 03-1 is optional pre-TI, right? It depends on the nature of the guaranteed living benefits. The short answer is yes. So that's correct. It's not optional. I think probably the point I was trying to get at in the slides is that, I guess from an investor perspective, kind of what they're seeing on the income statement or balance sheet, it's really just, hey, guaranteed living benefit or variable annuity or even just complicated liability. So I think as actuaries, we're trained and we can understand some of these technical details and differences. So, hey, in this situation, SOP 03-1 applies. In this other situation, FAS 157 applies. But for an ordinary investor, they're not going to be able to maybe understand at this level of detail. They have less information than us. There's a limited amount of information available in the 10K. I mean, at the end of the day, hey, there is guidance on in which situations you should apply which regulation. But I think kind of going back to the point of, hey, there's only one intrinsic value where, hey, these liabilities are still relatively similar. They're all, hey, guaranteed living benefits. And you have two different accounting frameworks under this. And this is going to kind of create confusion and a black box nature for the investor.
Yes, thank you. Thank you, Bill. I've got a question for Katherine. Under LDTI, since there's an absence of specific guidance, in your view, how is the net of reinsurance liability calculated? So, for a FAS 60 product, is it similar to, the process similar to what it is now? Is there just a discounted value of the net of reinsurance cash flows, and you'd use the direct writer's view of best estimate assumptions and, the new guidance for discount rates and, adjustments for non-performance risk?
Yes. So from my perspective, coinsurance is relatively straightforward. The reserve will be calculated very similar to what we do today, which is take a percentage of your direct, and obviously that direct reserve will be calculated as a present value of its liabilities, present value of premiums minus claims minus liabilities. On the YRT side, I think things are materially going to change. Before, most people were using approximations, holding an unearned premium or holding a cost of reinsurance type method. And you kind of had a little more wiggle room as to what you could do. And under LDTI, you will have to project all cash flows and then take your present value based on the discounted rate according to what they've laid out in the assumption setting process that Scott covered.
Thank you, Katherine. I've got a question up. I'll take this one. Is DLR, excuse me, disabled life reserves not impacted by the move to LDTI? I thought it was decided that the ALR and DLR can be projected together, and a company may choose to split or leave unsplit. Yes, I agree. I agree with the premise of the question. It is. It can be DLR can be moved under the LDTI framework. The first step is for the company to decide a classification for the disabled life reserves, and most of them now for disability income are classified as short-term liability. So if that's the case, LDTI wouldn't apply if the company continues to use the designation as a short-term liability. Now they could make the move and say that, like the question says, project them together and move them. What they are implicitly doing by that is saying that DLR is not a short-term liability; it's a long-term liability. So it's just something to discuss with your auditors in advance of your implementation and make sure everybody's on the same page that you're doing that. I mean, disabled life reserves for disability income and long-term care can be classified either way. So step one is to classify them as short-term or long-term, and if they're short-term, then LDTI does not apply. So hopefully I've answered the question there. I've got another question up. What is your thought on using PBR mortality credibility analysis for LDTI? So just some background, PBR mortality credibility analysis is just where at a high level, it's where a company experience might not be fully credible, especially for a medium-sized or small company. It's blended with industry experience to come up with a mortality assumption for calculating reserves under VM20. I think and it's weighted based on credibility. That's the point of the credibility analysis. The more experience a company has, or if they reach that full credibility level with thousands of observed claims, their credibility might be 100, and the industry would be 0, and there's not a point of the blending anymore. My thought on using that is I do think it's it is valid to use for LDTI to come up with an assumption. Especially if a company, a small or medium-sized company that doesn't have enough of their own sufficient experience. I think the mortality assumptions, the best estimate assumptions for like I mentioned, for VM20 and LDTI, they don't have to overlap perfectly, but if there are Venn diagrams, there'd be a lot of overlap. So. I've got another question for Bill here. Do you think that LDTI ends up converging GAAP and non-GAAP adjusted income measures, fully or partially? I mean, what are the most significant pieces of adjusted income measures that, in your view, that would remain after LDTI is implemented?
Yeah, thanks so much, Scott. So I think that's truly the billion-dollar question. I think the short answer is, I think, me personally, I hope so. I think kind of in my mind, I think things are a lot more economic post LDTI, which I think is a big reason why companies have adjusted operating measures. I think maybe some of the reasons that, hey, companies still might want to use adjusted operating measures. I think something you talked about earlier in the presentation, Scott, is, hey, that earnings volatility. So I think one of the hopes is that, hey, maybe earnings volatility is going to decrease post LDTI, but that's not necessarily going to be the case. I think in particular, I think at least for variable annuities, well, hey, my liabilities are measured at fair value, my assets are measured at fair value. That works if I'm actually hedging my business perfectly, but many companies aren't hedging, or they're not fully hedging to GAAP. So I think you could certainly have situations where some companies are going to experience more earnings volatility post LDTI rather than pre. So I think, at least in my mind, I think that's one pretty big determinant. I think that's still TBD. And I think that really varies company to company, in particular, how they implement their hedge strategy.
Okay, thank you, Bill. I had another question for Katherine. If there's co-insurance and the reinsurer pays an expense allowance that offsets some of the direct commissions and acquisition expenses. So under LDTI, what's the treatment of the direct commissions, the other direct acquisition expenses, and the expense allowance for DAC purposes?
Yes, so anything that is offsetting acquisition expense will roll into your DAC calculation and be held either as a contract, or you would want to calculate your DAC net of those expenses. From anything from an expense and maintenance kind of perspective, similar to what Bill mentioned earlier, you would bring in your expenses related to claims. You could bring them into the reserve, but otherwise they would just flow through. If they didn't meet that criteria, they would flow through your earnings.
Okay. Thank you, Katherine. I think we've got time for one more question. Bill, are there any, square pegs that we're trying to jam into round holes in the variable annuity space? Are there any products or riders that don't seem to fit well under LDTI guidance, or that are particularly challenging? And, what would be your process to address these?
Yeah, I think that's a really excellent question, Scott. So I think kind of the industry backdrop here with, hey, in the variable annuity space, hey, we have LDTI changing. On the stat side, we just had VA stat reform. We have all the M&A activity. So I think in particular, in addition to kind of the accounting changes, both on the GAAP side with LDTI as well as on the stat side, there's also pretty big product changes happening right now. So I think in particular, you think traditionally, hey, you have VAs with living benefits. Those sorts of products, obviously, they're still being sold, but I think a really big new entrant in the market is, I guess, what's called either structured annuities or index variable annuities. I think, at least in my mind, that's probably what's most complicated. These are still pretty new products. There's a lot less experience with, hey, well, what to go with. So I think, at least in my mind, that's probably where I think there's probably the most open questions, just given because those products are so new.
Thank you, Bill. Sarah, I think we're approaching the bottom of the hour. Would you wrap things up for us, please?
Absolutely. Thank you to everybody for watching this session, and thank you to our wonderful speakers. Please close out of this video to be directed back to the virtual meeting page where you will find the session evaluation. Please take a moment now to complete the evaluation and give us your feedback on this program. Thank you for joining us today.